Robinhood stock is down 68% off its high, and in this video, I'm going to argue why I think it's an undervalued growth stock that investors can consider adding to their portfolios. Now, even though Robinhood stock is down considerably off its high, it's performed well in 2024 as the company's important metrics have bounced and turned upward. I'm going to share with you its user growth, deposit growth, longer-term revenue growth, improvements in return on invested capital, and a strong balance sheet, all combined against a relatively favorable valuation as reasons why I think this is an undervalued growth stock that investors should consider. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So like I highlighted, Robinhood stock is down 68% off its high. However, if I change the chart to a year-to-date chart and look at how much the company has improved this year, you'll notice that the price is up to $22 per share, up from around $13 per share to start the year. So a nearly 100% improvement year-to-date in 2024, despite the fact that it's still down considerably off its longer-term high. Of course, Robinhood thrived during the pandemic when people were locked down at home and governments worldwide added stimulus checks to people's wallets. And so with more money and less things to do, people took to investing and Robinhood absolutely thrived. Through the economic reopening, it consolidated, it found it harder to grow. But still, I'm going to share with you, in recent quarters, it's returning to growth. So if you look at some of the key metrics for Robinhood, one of which I look at is funded customers. In the latest update, it had 24.2 million funded customers. That was a 270,000 increase from the previous quarter and over 1 million from the same quarter last year. So it has returned to growth in this very key metric. Furthermore, if you look at assets under custody, that also increased to 140 billion, up from 130 billion in the same time last quarter. And if you look at net deposits, 13.2 billion in net deposits was 2 billion more than the previous quarter. So Robinhood returning to growth and returning to getting more money from existing customers while adding new customers. Looking at its revenue growth longer term, you'll notice 2.2 billion in trailing 12-month revenue, up from around 900 million in 2021. So you can see this clear trend here. Economic reopening caused the company's trailing 12-month revenue to decline and consolidate for one quarter, and then it returned to growth in early 2023. And to make it more impressive is that revenue growth starting in 2023 really led the company to improve its profitability. Operating profit margin at close to 14% is way better than it was in mid-2022 at negative 160%. So despite a slower growth rate coming out of the pandemic, this is more valuable growth because this is growth profitably. This isn't Robinhood just going after all customers and spending lavishly to attract new customers. This is Robinhood growing profitably, responsibly, prudently, which is leading to improvements in profitability. And that's ultimately what investors want to see, is profitable growth, not the growth at all costs strategy. Looking ahead, the analysts on Wall Street that are following Robinhood stock, they expect the company will increase its revenue by 8% year over year to 2.84 billion next year. Now, that will be a huge deceleration from the current year, where the analysts expect its revenue will grow by 41% year over year. Now, if this 8% growth comes with improving profit margins, I don't think investors will be disappointed. However, if the slower revenue growth also leads to lower profit margins, I think investors will be disappointed. However, I don't think that's going to be the case. I think the incremental customers, the incremental revenue will lead to improvements in the company's profits and profit margins next year. Now, in addition to improvements in profit margins, the company's return on invested capital is also demonstrating excellent improvement. At 2.71%, the number itself is not impressive, but what is impressive is the trend of improvement. It was nearly negative 60% in 2021, and it's now improved to 2.7%. I wouldn't be surprised if over the next 5 years, this continues moving higher. What you'd like to see is a company's return on invested capital be at least 10%, because you want the return on invested capital to be above the weighted average cost of capital. That's creating shareholder wealth. If the return on the invested capital is above the cost of capital, you're creating shareholder wealth. Most companies have a cost of capital of at least 10%. That's why I say, as a general rule of thumb, you want to see at least 10% ROIC, which Robinhood is not there yet, but I wouldn't be surprised 5 years from now or 3 years from now if it is approaching and eclipsing that market, given that it's an app-based business, which could be lucrative at larger scale. So the potential is there for Robinhood if it can continue incrementally adding profitable customers and profitable growth as it has been over the last couple of years. Additionally, the company has a pristine balance sheet. Its net long-term debt, so this is long-term debt minus cash, is negative $4.1 billion. That means it has more cash than debt. It has actually $4.1 billion more cash than debt. And when you're a growth company, having this kind of balance sheet really improves your growth prospects. It opens up opportunities, for instance, for acquisitions, because you've got the balance sheet to pay for an acquisition. You don't have to pay the company in stock. You can pay the company in cash. If you need to borrow, you can borrow because you have the capacity to borrow. You have more cash than you have debt, and so you have room to borrow to make an acquisition. Or if you want to go after some growth opportunity that requires a large investment, but you feel as management that it's a reasonable opportunity that's going to deliver excellent return on investment, you can make it because you have the balance sheet to go after that opportunity. It gives you flexibility and it reduces risk, and that's great news for Robinhood stock investors. And finally, the last reason why I'll mention why I think Robinhood is an undervalued growth stock is because of the valuation. It's trading at a forward price to earnings of 21, which, given its prospects, given its total addressable market opportunity, given the business model and the potential for lucrative profitability, given its growth that it's demonstrating, I think it's a great price to pay for a company like Robinhood. Now, my one question mark with Robinhood, I'm not totally convinced of the management team. I haven't been convinced with the decisions that management's making. So that's one area of risk for me with Robinhood stock. Still, overall, the upside, the potential upside, is worthwhile for the risk that you would be taking with Robinhood stock, in my opinion, trading at this valuation with its prospects. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.